All right. So today I want to talk to you about how to begin investing, right? It's a very, very important thing to do, investing. You need to start doing it, and you probably should have started doing it 10 years ago, to be quite frank, unless you're starting a fund for your baby. So if you're just getting started with investing, there are three things that I want you to do. The first thing that I want you to do is I just want you to buy an S&P 500 index fund. Don't worry about cryptocurrencies. Don't worry about picking individual stocks. Don't worry about doing anything, right? Don't worry about bonds. Don't worry about whether now is a good time to invest. Don't worry about any of that. It's not important. None of that is important at this point in your investing career. And the reason why it's not very important is because you are not ready. Period. End of story. If you're a beginner investor, everything else is just, it doesn't matter. It does not matter. And the reason why it doesn't matter is because you have no idea how you're going to react to volatility. You need some volatility exposure therapy for real. And what that's going to look like is you buy this S&P 500 index fund, and then what you're going to do is you're going to put money in regardless of what's going on. If the market goes down, you put some money in. If the market goes up, you put a little bit more money in. And that's the important thing that I want you to do, is I just want you to basically pick a dollar amount, put it into the market every single week, and just live with that, right? And just put it in a really boring index fund. And here's the reason why I want you to do that. I want you to get used to the market going up and the market going down, right? It might not be optimal. Say you have $1,000 to invest and you go, okay, I'm going to split this up into 52 equal payments and we're going to put it in. A lot of people will tell you time in the market beats timing the market, and that is true. And they would say, hey, if you got $1,000 that you can invest, you should dump all of it into the market at once. I don't want you to do that. That is technically the optimal thing that you could do. I want you to split it up, and I want you to put it in slowly over time. And the reason why I want you to do that is very, very simple. I want you to understand volatility, right? I want you to understand what it feels like to put money in when the stock market is doing crappy. And I want you to understand what it feels like to put money into the system, into the market, when the market is up and doing great, right? Because right now, as a new investor, what you need is volatility exposure therapy. You need to understand what it feels like to put the money in and have the market crash the next day, right? You need to know what it feels like to put money in and it goes up. The way that you react personally to those two situations is going to tell you a lot about yourself. And the most important thing is that you just need to get a habit of, hey, market's up, we're going to put some money in. Market's down, I'm going to put some money in. If I have the money to do it, you need to understand what that's going to feel like, right? For the market to go up and for the market to go down. It's very important that you do that, right? Because the most important thing that you can do is just understand and put money in to the market and buy things and buy these assets that you need to buy throughout your investing career. You need to understand what it feels like to buy at the top. You need to understand what it feels like to buy at the bottom. It's very, very important that you get this. the important thing here is that you need to know what it feels like to lose money, and you need to know what it feels like to gain money and have an unrealized gain sitting there. And you need to be able to sit there with that unrealized gain, right? Otherwise, you're going to be a terrible investor. You need to know what it feels like to lose money and sit there with an unrealized loss. Otherwise, you're going to be a terrible investor. Because if you don't learn to do that one thing, that one lesson right there, what's going to end up happening to you is that you are going to start putting money in at the top of the market, and then you'll start pulling the money out of fear at the bottom of the market, right? So at this point, the number one thing that you can do is just start putting money away and get that volatility exposure therapy. All right, so that's thing number one. Thing number two that you need to do when you're a new investor is you need to start learning a system, right? And the system that I just gave you in step one is basically just dollar cost averaging into index funds, and that's a great strategy. You'll probably do really, really well if you just follow that one strategy. But there are other things that you may want to do. You might have other goals. You might have other things that you're trying to do with your investments. And I get that. And that strategy might not work for you for your particular situation. So what you need to do is you need to start developing a system around what your actual goals are, right? So while you're doing this volatility thing, you need to start reading, you need to start learning, you need to start understanding what it is that you want to do investing. Are you trying to get income? Why would you want that income? Are you trying to get growth? Why are you trying to get that growth? Are you trying to buy things super cheap and see the price appreciate? Are you trying, what are your goals? What are your strategies? And then you need to start building out a systematic process to do that. My process is that I start looking at the financial statements, and I start looking at discounted cash flow models and all that sort of stuff to get an idea of what the value of the company might be, and to understand that value, right? And then as I dive deeper and I get deeper and deeper into this company, that valuation that I did serves as a quick screener, right? If the price of things if the price is way more than the value, then I know just to move on, right? Because there's probably something else that I could be buying. If the price is way higher than the value that I've calculated, or sorry, if the value is way higher than the price, then I start digging deeper, right? Why is there a mismatch here? Was one of the assumptions that I put in wrong? Is there something going on here, right, that I should be aware of? Am I pretty close to the price? Okay, is there hidden pieces of value that I'm not seeing by reading the annual report? That's my process, right? Is I do the valuation first. It's a quick screen on the stocks that I want to buy, and I go forward with that. And I try to get a certain rate of return from my discounted cash flow model. And that makes me very comfortable when the market dips. But that's not to say that that's the way that you want to do things, right? The most important thing is that you have a complete process for your investing. And what could that look like for you? That could be a trading process, right? One of the quote best investors, and I take issue with calling him an investor, is Jim Simons, and he does fantastic doing pair trading and things like that, and little statistical arbitrage things using very mathematical stuff. That doesn't appeal to me personally, even though by trade I'm a statistician. I understand how it works. I understand statistical arbitrage. And I think that you could do very, very well doing it. It just seems a lot harder to me than uh, than what I do. And the reason why that seems a little bit harder to me personally is because first and foremost, I'm an economist, right? And I look at the capitalist system and I go, hey, I don't necessarily want to be out here trading back and forth, back and forth, back and forth. I just want to own some capital and get some rent off of that capital. That's it, right? And so that's what I do. Is I just buy great companies and let them produce, let them do their thing, and that's my personal bent on that. But you might want to do that statistical arbitrage, and you build a process around that, and you can do that, and you can do that really, really well. You'll make money, right? And there are other things that you can do, other processes, and so that's the second most important thing that you can do, is to build out your personal process, right? So while you're doing this volatility exposure therapy of just investing, putting money away into an index fund, you need to be developing a process. And if your process is just, hey, I'm going to dollar cost average into index funds, great, you don't need any other strategy, right? But the important thing is to just have the process in place, because the process, the more mechanical that you make it, the more it's just cranking the handle and you're getting results, the better, right? You don't want nuance. You don't want anything. You just want to crank the handle on your investing and have it produce results. So that's number 2. Find a process. Number 3, you need to make some mistakes. Give yourself some money to make mistakes, right? Create a little account that you're going to deem throwaway money. And I don't mean go gamble with this money, right? You could. What this money is for, and this is probably 6 months to a year after you've started your volatility exposure therapy, I'd recommend about a year, right? So keep doing that dollar cost averaging for a year, and then take some money and designate that as throwaway money. And the reason why you want throwaway money is very, very important here, because step number 2 was finding a process. You don't know if your process is going to work for you until you try it out. Okay? And what you need to do for that process to work is to basically waste some money. And I know that sort of sounds sacrilegious when you're talking about investing, but it's true, because what you need to do is you need to try out your personal process, your personal strategy. And it's so counterintuitive to say, when you're investing, throw away some money at the very beginning. I did this back when I started investing. I took a couple $100, I think, and I ran an experiment. I split it in half. I bought shares of Coca-Cola, and I said, I am never, ever, ever in my entire life going to sell these shares of Coca-Cola. That was half of the process. I'm just going to buy, and I'm going to hold on to them, whether they go up, whether they go down, whatever. It's just going to be an experiment. I'm going to hold on to these. The other half, I'm going to go try different things. I'm going to try trading. I'm going to try statistical arbitrage. I'm going to do this. I'm going to do that. I'm going to see what happens, right? I don't remember what happened to the money that I said that I was going to try, like trading and pair trading and statistical arbitrage type things and all this, that, and the other, and trying to be smart with the money. It didn't work, right? I have no idea what happened to that money 15 years ago. I might still have some of it. I can't remember. I really, really can't remember. But I still have those shares of Coca-Cola. And they haven't really kept up with the market overall. But here's the interesting thing. I know what they did. I still have them, right? And it turns out that after you adjust for splits and dividends with my shares of Coca-Cola, that I bought them at about $14 a share. And if you came to me and you said to me today, hey, Ryan, would you like, and you gave me the annual report for Coca-Cola and you said, hey, Ryan, here is the annual report for Coca-Cola. Here's how many shares are outstanding. Would you like to buy this company at $15 a share today? I would say yes. I'd say I will do that all day long, anytime you want. Like, I will pour as much money as I can into that at $15 a share today, right? It would be an incredible deal to do that. And that's essentially what I've done, right? Is I got it for $15 a share. Now that was 10, 15 years ago, something like that. And it's, I've got a triple so far on that money that I invested in Coca-Cola. And the thing that I thought was great, the thing that I know is that I've got this piece of a business over here, and it's doing its thing, and it's producing cash flow, and it's doing this, and it's doing that. And I realized that all I have to do is buy good companies, hold on to them, right? And that's the genesis of my process, right? Is that I did this little experiment. And that's the thing that I'm saying to you to do as well, is figure out what your process might be, and then throw some money at it. See what works for you, right? And those are the three things that I want you to do if you're a new investor, right? I want you to first do some basic index fund investing, dollar cost average into them. Don't do anything fancy. Do that for about a year. During that year, start researching some processes that make sense to you. And then after that year is up, give it a try. See what works for you. What's the process that actually works? If you do those three things at the very beginning of your investing career, you're going to be miles ahead of just about any other investor. I wouldn't do the testing process for much more than 6 months, right? Play around with it for 6 months, see what speaks to you. Don't do it for any longer than that. Once you've got a process that you're comfortable with, do that, right? All right, so that's all that I've got to say. Have a nice day. Peace out.